All right, let's get back to the markets this morning. Joining us is David Spika today, President and CIO at Guidestone Capital Management, and Megan Shu, Head of Investment Strategy at Wilmington Trust. Great to see both of you guys. David, let me start with you and ask, claims are looking a little bit better, but certainly not the improvement that we'd seen in prior weeks. Housing starts have missed, retail sales have missed, Philly Fed has missed. Is that good news in that it answers some of the concerns from those who were worried about overheating?
Yeah, I think some people are going to see that as good news because that does reduce the fears about overheating. But I would contest that the economy is just taking a slight breather. I think we're going to go back into a significant growth mode. I do think inflation is still a problem. The Fed clearly doesn't see it as something sustainable. They said again in April that it was transitory, and that's one of the things we're keeping an eye on. I mean, inflationary pressures are not something that we've seen in many years, and I don't think a lot of people in this industry know how to manage through inflationary pressures. So I do think the economy is going to continue to be robust. We're going to get more job gains, potentially more stimulus, and that's going to drive inflation.
Yeah, Megan, if those concerns are still acute and we're obviously still unanswered, whether it's transitory or not, how do you explain the action in bonds? Why hasn't the reaction been at least a little more violent?
Well, we got a pretty big step function upwards earlier this year. And so I think we've basically returned to those levels, but it's less of a shock this time around. How the bond market reacts is really a function of inflationary pressures, but also the response from the Fed. So I think what we might be seeing is expectation that inflation will move higher, growth will move higher, but still a market bet, if you will, that the Fed's not going to let this get out of control. And that would really be impacting the long end of the curve. We're still seeing the short end anchored, even though expectations for the first rate hike are moving into the end of 2022. But that steeper yield curve we see is really constructive for the equity markets, specifically value-oriented sectors.
Shepard Smith here. Thanks for watching CNBC on YouTube.